Stock market crashes are often the result of corrective economic actions taken by the government or the market to deal with several micro imbalances. For timely corrective action to be taken, you need responsible politicians and bankers to act on a timely basis before the majority of investors run for the exit in herd-like instinct and cause a stampede. If the country is dominated by greedy politicians who put their successes ahead of balanced growth, you will end up with bigger imbalances. Sooner or later, the inevitable must happen, and a drastic corrective action is forced upon the society at a great cost to the ordinary people who didn't cause it. Very often, the corrective action would be taken by the market vigilants, who realize that the current macro imbalance. This is especially the case in smaller economies with weak currencies. Let us look at the USA today. Quantitative easing, a fancy terminology of printing money, was a mean of avoiding the pain required to deal with the 2008 imbalances. This has led to a long period of slow growth at the huge cost of widening the very imbalances they should have corrected. Low interest rate, stagnant wages in real terms, increasing ratio of the national income going to the 1% at the expense of the 9%, and the level of increasing inequality and government deficit have become the new normal in a world ruled by the selfish few. Let's examine some of the symptoms of the current economic policies. Number 1. Low or negative interest rate. Low interest rate leading to a misallocation of resources, low productivity, and overborrowings. If banks are willing to lend money with 0% or very low interest rates, many people will be irresponsible and do reckless things with that cheap capital. It's just in human nature. If something is given to you with almost no cost, it won't be as valuable, and eventually people will start abusing it and start doing stupid things with it. Also, overborrowings cost too much money in the market. When too much money chasing fewer deals, prices will go up dramatically. Number 2. Increasing wealth differentials. Stagnant or retreating wages in real term has led to a lower standard of living and lower macro demand to sustain full employment. The central banks, with their QE and low interest rate, encourage the poor to borrow more to maintain the non-sustainable demand based on increased borrowings. Banks and other financial institutions have become intermediaries to recycle the excess cash from the rich, who have low propensity to spend, to the poor, who often cannot make ends meet. This unavoidably leads to creating an unstable consumer's mountain of debts and increased risk to the financial system as a whole. Number 3. Abandoning fiscal prudence. The government has abandoned any resemblance to fiscal prudence due to political expediency or due to voters' revolts. They accept to run increased deficits by reducing taxes or increasing government spending. This would lead to increased government borrowings and ballooning external deficit. The last US tax reduction is exactly the opposite of what the economy needed. If prudence was prevailing, and if anyone is caring about the fortunes of the future generations, leaving them with trillions of dollars in debt is undoubtedly an act of sheer irresponsibility. Number 4. External imbalance. As the nation consumes more than it produces, the external imbalance will balloon. This will invite resentment of current international trading order by those nations with big deficit. Without diagnosing the true reasons behind such imbalances, imposing tariffs would lead to increased consumption of the home-produced products and increasing the tax on those who can least afford it. It would also lead to economic uncertainty and reprisals. If the economy is at full employment, who will produce the increased demand for the local goods? Day of Reckoning. The day of reckoning will come when the voters become activists and demand greater share of the national wealth through higher wages, unless they lied to and put the blame for their misfortunes on foreigners, immigrations, or unfair international trading systems. Such lies cannot last for long, and facing the truth would come no matter how long it takes. The real signals for the financial vigilantes in the stock market would be: A. The working class starts to demand higher wages, leading to increased inflation. Higher interest rates will follow. B. The foreigners will stop lending the Americans to fund their external debt. This will lead to lower values of treasuries, hence higher interest rate. This time forced by the market on the economy. C. The financial institutions tighten their lending policies, making the recycling of cash surplus from the rich to the poor slower or more difficult. However, within the CEO's greed for higher bonuses, this is less likely to be a deciding factor. D. Getting into trade war with other countries and abandoning trade alliances with little care of the long-term consequences. F. Civil unrest. Burdening the young and the working class with mountain of debts and other social injustices could lead to civil unrest led by the students similar to the one which took place in 1968. A combination of these factors could push the economy over a deep cliff. The higher the imbalances, the greater the fall, unless politicians resort to even more temporary delaying tactics. However, when the final plan comes, and according to the law of gravity, it must, it will be very ugly this time, and it will lead to a collapse in the value of the dollar. The resulting social injustice will invigorate the working and middle class into action and demand their rightful share of the national economic. Let me know what you guys think about a potential stock market crash and our current economy. Leave your thoughts in the comment section below, hit that like button, and subscribe. See you guys in the next one.